Before we get into today's video, some regulatory compliance. My name is Andrew Alexander. I am Head of Investments for Three Counties, an independent financial advisor based in County Durham, England. This video is for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. As independent financial advisors and wealth managers, there is no commercial relationship between ourselves and today's guest. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. Past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. And now, onto the video. Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. Video number 4 now in our end of 21 market roundup and outlook into 22. And today we cross the channel into Europe with James Sym, manager of the River and Mercantile European fund. But as ever, before we get into the content, it would be marvellous if you haven't already subscribed for you to do so. It really does assist us in producing all of our content, gives us huge amounts of support, and we're just about to get to 200 subscribers, so it would be fantastic if we could do so before Santa comes down your chimney, and that's not a euphemism. So, on to the content. James, great to see you once again. Many thanks for tuning in. 21 has been a funny old year for many markets. Looking at Europe, how's the last 12 months been? And has there been much variance across this very disparate region?
Yeah, morning, Andrew. Good to see you. Happy Christmas. A bit early. Look, Europe's been an interesting one. I think, like every region, it started very strongly, didn't we, in 2021, as we saw the recovery from that second wave and so forth. We took a view actually in about the middle of the year that kind of we were at peak momentum, if you like. Obviously, we know that 2020 was very depressed in the second and third quarters for obvious reasons. And then by the time we got to the middle of the year, we felt there was a recovery. So the recovery was broadly played out. So you had this kind of, I hate to use the phrase, but it was a year of two halves in a way. You had a very strong value bias in the middle of up to the middle of the year, and then you've had a much more sort of neutral market. Much more neutral market since then, and we're recording this on the day of news of the new variant, so we'll see how that plays out.
Yeah, I wasn't going to mention that, but yeah, it's quite an interesting Friday today.
It's an interesting one today, I'm afraid. Anyway, but so taking the longer term view, I would say pro-cyclical stocks, as you would expect at the beginning of a cycle. Anything that's got sort of exposure to a strong economy has been good this year. Banks have had a good year for once in European equities. Some of the more defensive sectors have lagged. We've benefited from that broadly with our positioning. Going into 2022, I mean, I think there is still a pocket for recovery, actually. Normally by now, and especially given the strength of the economy coming out of the global pandemic, you might think everything's recovered. Actually, you've still got a bit of an opportunity within the consumer. The government is still stopping us spending our money how we'd want to, isn't it? So particularly on things like travel and leisure, particularly on things like hospitality, there's still pockets. Now, the obvious stocks like the airlines and the travel agents might not actually be the best place to play that. There could be some sort of underappreciated winners. So that's, I would say, from a macro perspective, that's our last call. But it's been a good year for equities. I think we're still relatively early in the cycle, and there are pockets that are still quite depressed. So I wouldn't be too bearish at this stage.
Yeah. Again, not going to touch on the news today, but we've seen lockdowns in Europe starting to form. Obviously, inflation seems to be the story that everyone's talking about at this moment in time. How is your outlook for 22 forming?
Yeah, so as I say, we've had a fantastic, let's face it, 15 to 20 years and more in assets. And that's been a function of falling interest rates. First and foremost, yes, the economies have grown. Yes, certain companies have been able to expand their margin. And of course, the internet and technology has been a fantastic boon for certain stocks, most obviously the FANGs. So that's the very long-term backdrop. Now, there is a chance, there is a risk that we're moving into a different regime, which is going to make your job a lot harder. You know, the ability to advise clients when every year inflation is high, and trying to keep up with that in terms of assets is going to be more difficult. Now, we're trying to build some of that protection into our portfolio. You know, what sort of companies don't just keep up with inflation, but what companies actually might benefit from some of this shift. The other big shift we've got, of course, is that transition from just doing monetary policy, so ever lower interest rates, ever more quantitative easing, to a more balanced policy mix where actually governments are kind of filling the demand gap. And you're seeing that through fiscal stimulus across Europe, but you're also, of course, seeing it in the UK as well. You know, my tagline is that Boris Johnson has become more Jeremy Corbyn than Jeremy Corbyn post the COVID crisis in terms of spending. So you're really seeing two quite seismic shifts. That's got big implications what equities we want to own. I think in reality, we shouldn't be expecting, you know, super outsized returns in 2022. We've had a good recovery, but equally, you know, I don't think we should be too bearish either, because although interest rates may go up somewhat, although there are inflationary pressures in the system, there's still that recovery element, and actually there are still pockets of value, frankly, in European equity markets, particularly in areas that have really struggled over the last cycle. So that's my sort of balanced view, as it were. It was very positive when we launched the fund coming out of the global pandemic. That's more advanced. I think you've had that. But equally, you know, there is still value in equities. So I'd be sort of cautiously optimistic is how I'd probably phrase it.
Yeah, and I think that, again, my view on Europe, I am you know, positive on Europe and positive on European equities, and one of the reasons being, and I know we've discussed this before, the huge opportunity spread that is across the region. You know, people forget that it's a group of numerous countries, all with some fantastic companies and technologies within. Looking at your fund in particular, have you had much change over the last 12 months, and how are you positioning the fund at the moment leading into next year?
I would say we have made some shifts. Okay. As I say, at the beginning of the year, we felt there was that real explicit opportunity for economic recovery. Okay, so that clearly informs the positioning, particularly around overweight to industrial businesses that were still depressed in Asia. By the middle of the year, we felt that broadly played out. So we made the portfolio more balanced, but with that exposure to the consumer recovery, which is delayed again with the news over the last few weeks regarding COVID. But it will come. Yeah. It will come through at some point, and we've got to be when that happens. The biggest shift. And trying to sort of extend our time horizon a bit rather than just, you know, what's currently going on, and it's a very clear opportunity for lots of European companies, is the energy transition, and we all talk about it, we all know about it, but we really are at the foothills of that change, and we're talking on some numbers, we're talking 6 trillion per year. Wow. Of capital investment, and that's between half and a third of the entire US economy. Yeah. And in Europe, we have been doing energy transition, environmental concerns, all that. We've been doing that for a long time, a lot longer than the US under Trump, a lot longer than the rest of the world, which is still just getting started. So although we've been talking about it for a long time, I'm not sure every part of the world has. And the reason I think that's so important is because if you look at the leaders in many of these technologies, it really is European companies that are able to do it, whether it's cable manufacturing, wind turbines, carbon capture, decarbonizing cement, producing green steel, all of the multitude of different ways. This is a much bigger opportunity than just wind farms and Tesla. Yeah. And in the same way that big tech really drove the US market to outperform over the last decade, there is a chance that the energy transition has the similar effect on European equities because we have such a big weight to those sort of companies. And we can export those technologies around the world. So if I'm looking for something really positive to say, it's a happy confluence as well, by the way, Andrew, of doing the right thing, improving society, but also generating fantastic investment returns. If I'm looking for something really positive, that's the area I'd focus on, and it's a big exposure for our fund.
Yeah, that's again a fantastically positive ending to the video, and again, you know, the performance that you've been able to deliver has been great, and let's hope that the market, you know, we continue to, the market's going to be what the market is, and obviously with your own particular skill set and process in the fund, and the focus upon that transitional change that's happening. Let's hope for a positive end of this year and a positive 22. James, as ever, it's been smashing to catch up with you. If I don't see you before, have a great Christmas, have a fantastic New Year, stay safe, and I'm sure we'll catch up soon.
Cheers. Thanks very much. Cheers, Andrew.